Nvidia has just crashed through the $4 trillion market cap barrier. Major U.S. equity indexes are sitting at fresh all-time highs. And retail investors, they've poured a record-shattering $155 billion into the market in 2025 alone. The CNN Fear and Greed Index is deep into extreme greed territory. But here's what's really interesting. While everyday investors keep buying hand over fist, the people with the best insider vantage point in Washington are doing the exact opposite. Congressional trading disclosures show a broad, steady shift from net buying in 2023 and 2024 to net selling so far this year, especially in 8 household name stocks that you probably own right now. Now, these same lawmakers have a decade-long track record of beating both hedge funds and the S&P 500. So if they're lightening up, it pays to understand why. In this episode, we'll break down the macro backdrop driving these stretch valuations. We'll go through 8 stocks members of Congress are exiting one by one. We'll look at valuation growth and institutional flow signals for each name. And I'll give you a quick intrinsic value check so you can decide whether to buy, hold, trim, or avoid. Remember, this discussion is for educational purposes only. Always do your own due diligence. Let's get started. So why is Congress selling Visa? Well, there are 3 main reasons. First, it's all about stablecoin adoption. Companies like Walmart, Amazon, and honestly, dozens of Fortune 500 companies are piloting what they call closed-loop stablecoin payment rails. And, that completely cuts out Visa and MasterCard fees. Second, we've got valuation stretch. Visa's forward price-to-earnings ratio is sitting around 30, which is actually above their 5-year average of 28. Third, institutional investors are turning. Q2 filings so far show 93 million in sales, compared to just 48 million in buys. Now let's talk momentum and fundamentals. Year to date, Visa is up 12%. Over the last 12 months, it's up 35%. Revenue compound annual growth rate is around 10%, and earnings per share growth rate is around 13%. Plus, they've beaten earnings estimates 4 quarters in a row. Here's our intrinsic value check. Using a discounted cash flow model with 10% top-line growth and a 9% weighted average cost of capital, we get a fair value of $379. So that suggests about 6% upside from current levels. For a 10% margin of safety, you'd want to buy around $341. The verdict? High-quality company, but trading at a modest premium and facing a potential structural headwind from stablecoins. That explains why lawmakers are trimming. Rating hold or trim pending a pullback. Why is Congress selling Alphabet? The Department of Justice antitrust ruling is due within weeks. Core search growth is slowing, and there's margin pressure in their cloud business. Year to date, Alphabet is down 7%, while most of their Mag 7 peers are up double digits. Now, from a valuation perspective, this gets interesting. Alphabet's forward PE ratio is around 19, which is actually under their 5-year average of 22. So theoretically, it looks undervalued. Institutions are basically net flat so far in Q2. But congressional exits in April through June total about $25 million. Our discounted cash flow model, using 10% growth, gives us a fair value of $200, which is right around the current spot price. For a 10% margin of safety, you'd want to buy around $180. The verdict? Fairly valued, but there's a binary Department of Justice overhang, rating neutral/hold. Why is Congress selling Micron? Well, many members who bought this stock in the low 70s last year are now up 80%, and they're locking in gains. There's also concern that cyclical DRAM and NAND pricing could soften into 2026. But there's still a major tailwind here. AI server demand is keeping 2025 and 2026 wafer starts very tight. Let's look at the metrics. Year to date, Micron is up 45%. Over the last 12 months, 508%. The forward PE ratio is around 10 versus their 5-year average of 12. So it still looks cheap on an earnings recovery basis. Our DCF model using 20% growth gives us a fair value of $124, which is right around current market price. For a 15% margin of safety, you'd want to buy around $112. The verdict? There's still runway here, but Congress is de-risking after a monster move. Rating: hold if you're long, wait for pullbacks to add. So, why is Congress selling AT&T? Well, the stock is up about 50% off its 2024 lows, but the dividend yield has compressed to just 4%. And honestly, there's very little organic growth. The revenue compound annual growth rate is less than 1%. The forward price-to-earnings ratio is around 13, compared to the telecom sector average of 8. Even the dividend is still recovering from previous cuts. Institutional investors have actually been net buyers for the last 4 quarters, but lawmakers are lightening positions by about $12 million in the second quarter. Now, our discounted cash flow model, using 2% growth, gives us a fair value of $27, which is exactly where the current spot price is. So, yeah, it's fully valued. If you're looking for a 10% margin of safety, you'd want to buy around $24. The verdict? It's a low-growth telecom trading at fair value. Rating avoid or income-only hold. Why is Congress selling Apple? Year-to-date, Apple is down 16%, underperforming the Mag 7 as iPhone unit growth flattens out. Apple executives are reportedly eyeing an AI startup called Plexi to try to fix Siri. The forward price-to-earnings ratio is around 29 compared to their 5-year average of 28, so there's a mild premium despite slowing revenue and earnings. Looking at the growth outlook, sales compound annual growth rate is projected at 4%, and earnings per share are expected to grow 10 to 12%. 3 of the next 4 quarters are forecast to have low, single-digit earnings per share increases. Our discounted cash flow model, using 8% growth, gives us a fair value of $200, which is right around the current spot price of $200. For a 10% margin of safety, you'd want to buy around $180. The verdict? Congress is basically booking profits after a decade-long 550% run. Rating neutral/hold. Why is Congress selling Novo Nordisk? Trump's proposed a 200% tariff on imported GLP-1 weight loss drugs, and, well, that's really spooked sentiment. Shares are down 50% year over year and down 20% year to date. But here's the thing, the fundamentals are actually strong. Revenue is up 24% year over year, with 21% forecast going forward. The forward price-to-earnings ratio is around 16 versus their 5-year average of 30. That's deep value territory. Our discounted cash flow model, using 14% growth, gives us a fair value of $82, compared to a current market price of $69. That's 19% upside. For a 10% margin of safety, you'd want to buy around $74. The verdict? Policy overhang is dominating, and Congress is de-risking. But for long-term growth investors, this could be a contrarian entry point. Rating speculative buy, but monitor the policy landscape. So, why is Congress selling Broadcom? I mean, the share price is up like 60% year over year, and that's 20% just year to date. We're seeing it hit new all-time highs. Now, the forward price-to-earnings ratio is sitting around 38, which, is a lot higher than their 5-year average of 18. That's a pretty severe premium. But here's what's interesting. Institutions are still net buyers. We're talking about $216 billion in buys, compared to just $37 billion in sells over the last 12 months. All right, let's do a quick DCF sensitivity check. If we assume 20% growth, we get an intrinsic value of about $258 versus the current spot price of $278. So that's roughly 7% overvalued. Broadcom would need to post more than 25% sustained growth just to justify that current price. The verdict? Congress is cashing in, but institutions are still adding. Momentum traders might want to hold, but honestly, valuation investors should be cautious. My rating? Trim or avoid new buys. Why is Congress selling Nvidia? Well, we're talking about a historic 32,000% return over the last decade, a record $4 trillion market cap. When lawmakers are sitting on life-changing gains like that, even small percentage trims create big dollar figures. But here's what might surprise you. Nvidia still looks cheap relative to its own history. The forward PE is around 34 versus their 5-year average of 42. Growth forecast shows revenue up 60% in fiscal 2026 and earnings per share up 29%. Our intrinsic value check is fascinating. Using a DCF model with 20% growth, we get a fair value of $164, which is right around the current spot price. But if we use 25% growth, we get $229. That's 40% upside. For a 10% margin of safety, you'd want to buy around $147. The verdict? Nvidia is at fair value, assuming mid-20% compound annual growth rate going forward. Congress taking profits isn't necessarily bearish. Rating: long-term hold. Accumulate below $150. So here's what we're seeing. Extreme retail greed, record-high indices, and stretched valuations are convincing many lawmakers to lighten up on stalwart names, even when the fundamentals remain sound. Here are your key takeaways. First, watch the policy landscape. Tariffs, antitrust rulings, and stablecoin regulation can swing sentiment overnight. Second, mine valuation versus growth. Many of these stocks remain compounding machines, but even great businesses can become poor investments at the wrong price. Third, follow the flows, not the crowd. Retail investors are buying record amounts, while institutions and Congress are selectively cashing in. Which of these 8 names are you buying, trimming, or avoiding? Let us know in the comments below. If you found value in this analysis, smash that like button, subscribe to the channel, and hit the notification bell so you never miss our next deep dive. Happy investing, everyone, and remember, always do your own research.